on Kotak Mahindra Bank, but it is also earnings season. HUL out with its numbers. We do have the management addressing the press on the quarterly performance. Let's listen in.
Backed by our distinctive capabilities, will enable us to continue winning in the Indian FMCG sector. Let me talk briefly about the progress we have made in each of these. We are a powerhouse of big purposeful brands. We have a total 19 brands clocking over 1,000 crore turnover each annually. Put together, these 19 brand account for 80% of our turnover. During the year, we have focused on contemporizing our master brands through the lens of unmissable brand superiority to serve evolving consumer needs. We continue to invest disproportionately in market making and premiumization. We have not only seeded categories and formats, but have successfully built them to scale. This portfolio contributes to more than 25% of our business and has grown double-digit in this financial year. Moving on to an update on reshaping our portfolio in beauty. We are focusing on, number one, contemporizing our master brands. Number two, investing behind 6 identified high-growth demand spaces like sunscare, facial cleansing, and serum. We have built a strong 2,000 crore plus portfolio across these big bets, growing handsomely, and we continue to scale them up. And 3, embedding capabilities across supply chain, mental reach and media models, and thought leadership. Through these actions, we aim to build a future-fit portfolio and capabilities that will enable us to meet the evolving needs of Indian beauty consumers. Coming to winning with customers, our effective coverage and assortment both have seen a steady rise at 1.2 times and 1.25 times financial year 20 levels respectively. Our eB2B app Shikhar continues to be a strong point of differentiation for us, and we have now successfully onboarded 1.3 million stores on Shikhar till now. We have elevated our execution excellence by amplifying our in-store activations and partnerships with customers in modern trade and e-commerce. As a result, our focus action, we have increased our on-shelf availability by 200 BPS in modern trade and online availability by 500 BPS in e-commerce. Considering our performance in the year, the Board of Directors have proposed a final dividend of Rs 24 per share, along with the interim dividend of Rs 18 per share. The total dividend for this year is Rs 42 per share, which is an 8% year-on-year increase. Moving on to March quarter 24 results. Underlying volume growth was 2% in the quarter. Pricing continued to be marginally negative, leading to underlying sales growth of 1%. EBITDA margin at 23.4% remained healthy. Profit after tax before exceptional items and profit after tax declined 3% and 6% year-on-year respectively. Coming to performance across the 3 segments, home care and beauty and personal care segments continued to see negative price growth in the quarter. Home care grew 1% with mid-single-digit volume growth. BPC underlying sales growth declined by 2%, with volumes remaining flat. Foods and refreshment, on the other hand, had positive pricing and delivered mid-single-digit USG with flat volumes. Overall, 75% of our business is growing volumes. In fact, 50% is growing volumes in mid to high single-digit. Margins in all 3 segments remained healthy, with home care and foods and refreshment at 19% and beauty and personal care at 26%. Next, let me elaborate on EBITDA margin delivery for the quarter. EBITDA is at a healthy level of 23.4% despite headwinds. Gross margins at 51.3% has improved 350 BPS through our end-to-end net productivity program. A&P at 10.8% is up 200 BPS as we continue to step up investments behind our brands, including in digital media. Employee benefit and other expenses at 18% is up 120 BPS year-on-year. On a full year basis, these costs are in line with our long-term trends. The termination of consignment sales agreement with GSK will have an impact of 60 BPS starting this quarter. Let me now move on to our outlook. We expect FMCG demand to continue improving gradually. Forecasts of above normal monsoons and improving macroeconomic indicators augur well. We expect our price growth to be low single-digit decline in near term. If commodity prices remain where they are, we envisage price growth to plateau in mid-term and price to become positive in low single-digit range by the end of this financial year. We will continue to generate savings through our productivity program and reinvest it behind our brands and long-term strategic capabilities while maintaining EBITDA margin at current levels. While we expect near-term demand to recover gradually, we remain very confident of mid to long-term opportunity in Indian FMCG market. India's booming economy, expanding affluent population, accelerating digital transformation, coupled with under-indexed FMCG spends, will provide companies with a strong runway for growth. With our distinctive capabilities and our strategic thrust of transform to outperform, HUL is well placed to capture this opportunity. With this, we complete our prepared remarks, and I will take questions.
First up, the numbers are absolutely in line with what the street was anticipating. That's not to say that the street was anticipating much. My question is a two-part question. The first one is on macros itself. At what level is your confidence as compared to a couple of quarters ago when it comes to volume recovery in the industry? And the second part, more specific to parts of your portfolio. One, at what level of discussions or deliberations are you on your ice cream business? And secondly, with Horlicks, what's the prognosis here with what has happened with regards to it being taken off the health drinks from a lot of these e-commerce platforms? So what your strategy is here?
So let me cover macro and Horlicks, and I'll give ice cream to you. So overall on macro, the way we see on rural, we had spoken about that rural usually is always accretive to FMCG demand. And we had seen that was an area of overall business which had seen in macroeconomics, given the amount of cumulative inflation and the demand outlook, we've seen a purge of disposable income. And hence we've seen rural demand coming off. That we have started to see gradual recovery as we had expected. Is it playing the role of being accretive to FMCG? Answer is no. But is it improving sequentially? Answer is yes. The hope with, we have seen good forecast of monsoon, and with overall macroeconomics, I do expect the recovery to continue to happen. What is leading the growth for FMCG this point in time is urban. What is leading growth is organized sector, which is modern trade and e-commerce. What is leading growth is premium. In that part of the business, we have seen growths have come back properly, and we've done a pretty good job as Hindustan Unilever in those parts of the portfolio. And hence, the key watch-out will be continued recovery of overall FMCG, especially the rural demand from where it is. Coming to a question of Horlicks, overall we have grown pretty decent again in this quarter, driven by volume growth and limited amount of price growth, which was the reason of, we had spoken about commodity price increases in barley, wheat, and milk, which have started to plateau down. So we have some amount of price growth and volume growth put together. We have grown in high single digit in Horlicks. So it's a portfolio where the job of making the portfolio stronger, the plus range which we have activated across the country, the margin job that we had in terms of unlocking operating efficiencies, all those have been done very well. And we do believe where we are with increased penetration that we have done in the last few years and improved market share, this business is yielding good results. As we've spoken last time, the key focus for us is to keep driving consumption. And hence entire home to home and building consumption is our focus priority.
No change of perception due to all that has happened with regards to all these MFDs, where they're looked at, there is a lot of sugar in it, etc. It's not as healthy.
Functional nutrition is important for the community. We know that large part of even the more urban population is deficient in micronutrients. So the category has a clear role in the life of the Indian consumer. It's still underpenetrated. For instance, our portfolio, which is the high science adult functional portfolio, is already in excess of 500 crores and it's going very, very well. So we are serving, and so far as sugar is concerned, we have in any serving of Horlicks, far less than a teaspoonful of sugar, added sugar. There's of course sugar that comes with the preparation itself, but the added sugar is amongst the least in the industry. So I don't think this is of material significance to us. And also the recent discussion is more to the infant category, which we don't participate in.
Right. I just want to know, is there any conversation you're having with any of the authorities for that? Because yes, there is some sugar content in all of this, but is there some rule requirement that is there from any of the authorities?
We are fully compliant with FSSAI, but also Unilever nutritional standards to the highest degree, and it's all fully compliant. So our job is to essentially grow the business by serving our consumer, and we are growing penetration in nutritional functional drinks. We are growing market shares. Our recent moves have been yielding results, and as I said in the previous conversations, we have to stay the course. There's a long runway for this category, but it requires us to stay disciplined, and particularly the more premium end of the category is growing very well. And we're very excited about that opportunity, whether it's women's health or diabetes and other conditions that we are helping solve. Yeah.
So on the ice cream business, if you can throw some light on
Sure.
how has been the performance during the year?
Well, that is Rohit Java, and we will revisit the numbers with